realize that we predicted this entire fire problem that we're going to have in Southern California before it ever happened? No, go look back. We online in real time talked about this entire mess. Unfortunately, the point is we saw this coming. Everything we said is coming true right now, meaning the poor are going to have to provide for and rebuild the homes of the rich down in Southern California. Now, you can't make this stuff up. What's often referred to as California's insurance crisis has been years in the making. The devastation coming from the Camp Fire near Chico in 2018 caused an estimated $16.5 billion in problems for our insurance companies. In 2019, the number of homeowner policies in California that were not renewed jumped to more than 30% in 2023. Now, two giant insurers, well, we know State Farm and we know Allstate, they announced that they would stop writing new policies or values on homes for properties insured in the state of California. State Farm said that they're going to move in response to the inflation that is rapidly growing catastrophic exposure. So last summer, they canceled all of their policies, all of their coverage for more than 1,500 homeowners in Pacific Palisades alone. You know, the area that's burning down right now in Southern California. So they moved that money into what? Well, they moved it into non-qualified mortgages. But again, here's what you need to understand. There are several reasons, quote, that catastrophic insurance in California in recent years has been growing. What is that? More people are moving into the state of California, and they're moving into areas that are a high prone risk for these type of fires. So in the same sentence, we talked about mismanagement, and we lay the blame on climate change. But here's the deal. Now, right now, this is climate sustainability. And until we acknowledge that, we're not going to face down the next set of disasters that are literally on the clock right now. And oh, by the way, if you live in North Carolina right now and the floods that you just recently had to deal with, it turns out that the only people that our politicians are concerned about are those who are rich and happy living in the West. Sorry to say that, but it seems to be the truth. Well, my friends out there, did you know that non-QM loans are about to get better in price? Yeah, you heard me right. They're going to get better in price in a market that's seeing rates go up all the time. Why is this? Well, they try to find ways for you to qualify these loans. Agency loans are Fannie Freddie stuff. They try to find a way to disqualify you from these loans. So if you're dealing with jumbo or non-owner occupied deals, your non-QM stuff, it's probably going to get better and a lot better in the near future. But we have to ask ourselves, why is this taking place? Now, the insurance industry of all people is not having a good day right now. They're not having a good day at all. And they're sitting on a whole bunch of money right now, and they're trying to find a way to what they need to do with that. And what they don't want to do right now with our hazard insurance policies is they don't want to deal with their primary objective, which is to write insurance policies on properties right now. It's kind of like McDonald's going out there right now and saying, hey, listen, we don't want to make French fries anymore. It doesn't make sense. So what they're doing is they're looking at different places where they could put all of this money, and what they found is non-QM loans. Get a load of this. New relationships are forming between insurers seeking long-term debt investment and managers specializing in origination loans, securitization, and the sale of mortgage-backed securities. This new dynamic that we find ourselves in right now has encouraged many investors to look at alternatives for their assets for yield and raising a burgeoning interest in the non-qualified mortgage securitization space. So all that insurance money is going over into loans right now. So here's the good news. Your clients are probably going to get totally hosed right now on their insurance policy, their hazard insurance policy that they're getting written on their house right now, but they're probably going to get a better rate. That is, if you, a loan officer, is writing a non-QM, a non-qualified mortgage. Because the insurance industry is moving their troves over to our troughs in non-QM money, and that's going to bring rates down. Now, loan officers, non-QM is going to make a big move in our industry, and you need to be the one who understands this whole thing. It has to be your top priority. Now, talk to my friends over at Oaktree, because they're going to make you an expert on the language of non-QM, which is exactly where you need to be.